This is the most relevant and interesting topic for all those investors who are waiting on the sidelines for this ever elusive correction. If you go back and look at the pre election predictions, experts are talking about three scenarios: the best case, the neutral, and the worst case. In the best case, they were talking about this ruling regime coming back with a bigger count than the 2019 tally. The neutral case, the prediction was they will just manage to scrape through the halfway mark. And in the worst case, they will significantly fall behind the halfway mark. These were the three kind of predictions for the markets from the election results. Here we are, the election results are out. It is the worst case scenario which has come to manifest. Did the markets play to the script predicted by the experts? Of course, no. The markets are hitting new highs day after day as if there is no tomorrow. So what's happening? Will the markets ever correct at all? What can bring these ever rising markets down? Hi everyone, welcome to the new edition of our video post. As always, through all our editions, our focus is to share valuable insights in the world of investments and markets. This edition will be no different. Hope you find this edition too very informative and interesting. So what we're going to look at in this edition is to look at most pressing questions that's bothering investors now. With this ever-rising markets refusing to give an opportunity for entry for the investors who are willing to come into the markets, they are wondering whether this market will correct at all, the way it's going up day after day. What can really bring these markets down? To find that out, let's look at some of the factors, key factors usually cause or trigger a major correction in the markets. Will any of them play out in the current market environment? That's what we're going to look at. The top factors that usually cause corrections are the massive FIs pull out, any macro accidents, macro risks, or regressive policies from the ruling regime. So let's look at one by one. Let's find out how we stand against each one of them. Let's take the first one, FIs pull out. Here, I think it's easy to clear. FIs are already pulling out from Indian markets for quite a while. In April, they pulled out about $1 billion. In May, it was over $3 billion of FI selling. In June first week, it was over $1.5 billion. It is another matter from June second week, they have come back to Indian markets. But still, they have been pulling out for a while. And it hasn't cracked our Indian markets, thanks to the support from domestic investors. So FI alone pulling out, will it cause major correction for the markets? Very unlikely. We need more ingredients for the market correction than just FIs pull out. While we are here, it's also relevant to look at how so much money is waiting on the fence from FI side to get an entry into India from countries like Europe and Japan, which are yet to taste the India story. So it looks like there is no luck or hope in the first risk. Looking at the second risk, it's again not very difficult to understand this risk and how it will play out in terms of macro accidents. None of the macro risks that can trigger major correction are lurking anywhere around the corner, be it corporate balance sheets, be it bank balance sheets, or the macro stability. None of them are anywhere close to even amber, leave alone red flags. Contrarily, macro is so strong that they are radiating color of pink all around. Just look at the numbers in terms of fiscal, tax collection, current account deficit, the currency strength. The macro has never been this stronger for India. Even looking at the growth, one can find there is a lot of runway for growth from the investment cycle. Just to share a growth number from the perspective of investment cycle, Look at the share of investments as a GDP. Currently, we are at about 5%. If you go back and look at the last cycle, 03-10 cycle, the investment to GDP ratio went all the way up to 17%. Currently, we're at about 5%. Even assuming that 17% was excessive, even if you assume that we will somewhere head to about 10%, there's a lot more runway for growth in terms of investment cycle for India. So looking at all this in terms of macro stability, again, this risk is unlikely to play out for the markets anytime soon. Now, having cleared the air for the first two risks, let's look at the third one, very interesting one. Here, the answer is not going to be so simple. It's difficult to predict which way the wind will blow here, which is regressive risk from regressive policies. Though there is a consensus view on all-round optimism on the progressive policies from the current ruling regime, one can't be very sure, especially given the experience of 2019 post-election full budget. In that budget, the finance ministry came out with a surprisingly regressive policy of super rich surcharge in 2019 full budget, which triggered a massive pessimism across the markets. Though current ministry has been there for 5 years and there is a potential stability of policies, one is not really sure what changes this current ruling regime will resort to as a response to the not so positive outcome from the election results. That can be a key monitorable risk in the coming months. So fairly one thing is very clear from the above discussion, that none of the risks are likely to play out for the markets anytime soon. Of course, risk can come from unknown angles, unknown side, which is normally the case for markets. Unknown is really unknown, so one can't really play for that. But the top risk, the known risks are unlikely to play out for the markets anytime soon. Given that, how does investors deal with this ever-rising markets? In our view, the only way the investors can deal with this market is to ignore the macro and be stock specific, bottom up stock specific, and phased manner look at building portfolio using the wobble or the cool off or the consolidation that comes once in a while in this market. It's not that the market doesn't give you that wobble. Just go back and look at the small cap index, how it has played out in the last few months. In the month of February, it hit a high about 47K. And then all the way down to about 42K in the month of May. That we are talking about a 10% correction at the index level. At the stock level, many of the stocks saw drawdowns of close to 20 to 25%. Such kind of wobble can come anytime in this market, especially when it is trading at a very expensive trading multiple. And also, I think if you look at, we have risks that could potentially come from the impending full budget or from SEBI's tweaking of F&O regulations. Already there is growing noise that the current finance ministry might look at categorizing the option trading income as a speculative income. So these are the risks, again, which can create a temporary wobble, cool off or consolidation in the coming months. When it comes, investors, instead of waiting to time the bottom or waiting for a very sharp correction, they should use such wobbles and cool off to build portfolios in a very phased and stock specific and bottom up manner, or allocate to money managers who can do this construction in a phased manner. This seems to be the only sensible approach in this ever rising market, which is refusing to give a window for investors who are sitting on the sidelines. With this, let me conclude. Thanks a lot for watching. If you liked it, please give a thumbs up and share this edition with your friends and network. Also, please don't forget to subscribe to our YouTube channel for regular updates. Thanks a lot. Stay tuned to our YouTube channel. Happy value investing. See you in my next.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.